If you're a company director in the UK, the recent autumn budget may have raised understandable concerns, especially if you're thinking about retirement planning, long-term wealth, or how future tax changes might affect you. You've worked hard to build a business, you've taken risks, supported your team and your clients, and now you're seeing headlines about tax pressures, frozen thresholds, changes to dividend taxation, and adjustments to savings incentives. It's natural to wonder what this means for you. Well, in this video, I want to do three things. I want to highlight some of the areas discussed in the budget that may be relevant to company directors. I want to outline the key allowances and frameworks that are still available within the current tax system. And I want to show how having a clear, long-term plan can help you make informed decisions with confidence. Now, this isn't personal financial advice. That always requires a regulated one-to-one conversation. But it is a way to help you understand the landscape and what still remains within your control. So why does this budget feel uncomfortable for many directors? Well, many of the directors I've spoken to have expressed similar concerns. A number of recent announcements and ongoing thresholds can affect business owners, including the income tax thresholds remaining unchanged, meaning more people may drift into higher bands as incomes rise. Dividend taxation increasing, which affects those who draw profits in this way. Adjustments to the taxation of interest and property income in future years. We've planned restrictions to salary sacrifice, which is a national insurance efficiency from 2029. And changes to ISA limits for certain age groups from 2027. And of course, inheritance tax threshold remain fixed, bringing more estates into scope as assets values rise. So if you've been thinking, my income is being taxed more heavily, my dividends won't stretch as far, and I'm concerned about passing on my estate, those feelings are completely understandable. But while the landscape may be more complex, it's not without structure. Careful planning can still make a meaningful difference. So what's still available? The key allowances and levers that we have. Well, despite the noise, the tax system still provides several important allowances and reliefs. The key is using them intentionally. Firstly, pension contributions. Pensions remain one of the most widely used long-term planning tools for directors. The standard annual allowance for pension contributions is currently £60,000, subject to tapering for higher income. The tapered annual allowance can reduce this for individuals with higher levels of income. So planning around this is essential. The former lifetime allowance has been replaced with new lump sum limits, which still require understanding. Because in many cases, companies can make contributions on behalf of directors, potentially attracting corporation tax relief. Even with future adjustments to national insurance efficient salary sacrifice, pensions remain a central part of long-term planning for many business owners. And we have ISAs. Now, individual saving accounts continue to offer a tax-efficient way to save and invest. While future changes have been proposed to cash ISA limits for certain age groups, the current system still allows individuals to shelter up to £20,000 each year. For many directors, ISAs act as a flexible, accessible complement to their pension planning. We have dividend allowance and profit extraction. Dividend taxation is due to increase. The dividend allowance has been reduced in recent years. This means the traditional salary plus dividend approach may need more careful consideration. Rather than relying on a single method of extraction, directors may benefit from reviewing their salary, dividends, employer pension contributions, and other benefits in kind as part of a joined-up strategy. Then, of course, we have capital gains tax. The annual exempt amount for capital gains tax is now only £3,000. While smaller than before, this allowance can still play a role, especially for those holding investments outside tax-advantaged accounts. There is, of course, inheritance tax. With IHT thresholds frozen, more estates may exceed the new rate bands over time. For business owners with property, business assets and investments, this highlights the value of understanding business relief where applicable, making considered lifetime gifts and using pensions effectively within the estate planning rules, and planning early rather than reactively. So why joined up financial planning matters more after this budget. The budget has introduced a range of changes that can make financial planning feel more complex for directors. Without a clear approach, there's a risk of missing available allowances, drawing income in less efficient ways, facing higher overall tax over time, and leaving potential issues unaddressed until later in life. On the other hand, directors who engage proactively can align profit extraction with their long-term plans, make structured use of tax advantage wrappers, prepare early for changes, and ensure decisions reflect both business needs and your personal goals. So, bringing it all together, the overall tax environment may feel tighter. Many of the key planning frameworks still exist. Directors still have the ability to use pension allowances, subject to tapering, ISA allowances, dividend and CGT allowances, and established IHT planning structures. The difference now is the need for clarity, structure, and joined up thinking, rather than letting changes accumulate over time. With a coordinated plan, you as a director can still work towards the retired lifestyle you want, protect your family, and navigate change with greater confidence.